Chapter 3, Cost, Volume, Profit Analysis, and Pricing Decisions. In Chapter 3, you will begin to use managerial accounting information to support managers' decision-making activities. Managers at Universal Sports Exchange, one of CNC Sports' customers, are evaluating two business opportunities in response to the lower-than-expected sales the company had last year: a $50,000 advertising campaign and a 10% reduction in sales prices. Before deciding which of these options to implement, the managers want answers to several questions. What will happen to sales volume if Universal implements these changes? What effect will the changes have on the company's operating income? These are questions that managerial accounting information can help answer. In Unit 3.1, you will learn how to perform break-even analysis. Break-even analysis is one tool managers can use to evaluate business opportunities. What does it mean when you ask if a particular business venture is going to break even? It means that you don't want to lose money. In other words, you want to earn just enough revenues to cover all of your expenses. At this sales volume, the income statement will show that total revenues equal the total expenses for the period. When you break even, there is no profit. You haven't lost any money, but you haven't made any money either. There is only one level of sales at which the break-even relationship is true. If the company were to sell one unit less, it would lose money. If the company sold one unit more, it would make money. This is all driven by the contribution margin per unit. The sales volume at which the total revenues equal total expenses is called the break-even point, and the break-even point can be expressed in terms of sales volume or sales dollars. Let's explore how to calculate the break-even point. Think about the contribution format of the income statement and the profit equation that is embedded in the income statement. As you recall, sales revenue minus variable expenses minus fixed expenses equals operating income. How might we use this equation to calculate the break-even point? If we know the sales price per unit, the variable cost per unit, and total fixed expenses, we can fill in those values and set the profit equation equal to 0. Solving for the number of units will give us the break-even point in terms of sales volume. Recall that the selling price minus the variable cost per unit equals the contribution margin per unit. So we could start by using the contribution margin times the number of units sold minus the total fixed expenses and setting the equation equal to 0. Why do we set the equation equal to 0? That's because the definition of the break-even point is the sales volume at which operating profit equals 0. Let's explore calculating the break-even point for Universal Sports Exchange. Here is the contribution format income statement for the latest period. We can use this statement to determine the break-even point. The sales price per unit is $20. Variable cost per unit are $16. Total fixed expenses are $168,000. We can now put this information in our profit equation to solve for the break-even point. Notice that the equation is set equal to 0 because that is the operating profit at the break-even point. This gives us a contribution margin of $4 per unit. Solving this equation reveals that the break-even point is 42,000 jerseys. If we do some algebra on the profit equation, we can arrive at a shortcut to calculate the break-even point in units. Dividing total fixed expenses by the contribution margin per unit will give us the break-even point in units. At Universal Sports Exchange, fixed expenses are $168,000, and the contribution margin per unit is $4. Using these amounts in the shortcut formula yields the same break-even point we calculated earlier, 42,000 jerseys. This shortcut works because the contribution margin per unit is the amount that each unit sold contributes to covering fixed expenses. And to break even, we have to generate enough contribution margin to equal the fixed expenses. Another break-even point that is sometimes used is the break-even point in sales dollars. To calculate this break-even point, divide total fixed expenses by the contribution margin ratio. For Universal Sports Exchange, the contribution margin ratio is 20%. So dividing $168,000 in fixed expenses by a 20% contribution margin ratio yields a break-even point in sales dollars of $840,000. Of course, we could also get this break-even point by multiplying the 42,000 break-even jerseys by the $20 sales price. Here is a break-even graph for Universal Sports Exchange. The blue line represents total sales revenue. It begins at the origin where sales volume equals 0. This is because if no units are sold, there is no sales revenue. The line increases at a slope equal to the sales price per unit. The green line represents total expenses. Notice that it intersects the y-axis at the point equal to total fixed expenses, which is $168,000 for Universal Sports Exchange, and the line increases at a slope equal to the variable cost per unit. This line also shows that the total expenses for Universal Sports Exchange are mixed, with a fixed and a variable component. Notice where the sales revenue and total expense lines cross. This is the break-even point, where total sales revenue equals total expenses and profit equals 0. The area shaded in green represents an operating loss. Notice that the sales volumes for this area are below the break-even point, indicating that we have not sold enough units to cover our fixed expenses. The area shaded in blue represents operating profit. Notice that here the sales volumes are above the break-even point, meaning that we have sold more than enough units to cover our total fixed expenses. Another concept that managers may use in addition to the break-even point to assess operations is the margin of safety. The margin of safety is the level of sales achieved above the break-even point. Going back to Universal Sports Exchange, current sales are 52,500 jerseys. With a break-even point of 42,000 jerseys, Universal has a margin of safety of 10,500 jerseys. That's current sales of 52,500 jerseys minus 42,000 jerseys at the break-even point. If we convert this to sales dollars, the margin of safety is $210,000. What does this really mean? Using this example, Universal could sell 10,500 fewer jerseys and still not lose money.